Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Happy Friday, everybody, and happy Inauguration Day. You know, regardless of your political stance or beliefs, I personally think this is just always a pretty impressive day just to see a peaceful transfer of power. So, happy Inauguration Day, everybody. Well, interest rates finished the week worse than where they ended last week. You know, rates mounted a comeback after Christmas and started to really improve. We saw that stall out last week. That was primarily due to some auctions going on. So there was just more supply, less demand, and that caused the prices to actually go down and yields to go up. And we saw that continue throughout this week. So rates have stalled a bit, and we've actually broken beneath some pretty important what were support lines, now are resistance lines. So in order for us to mount some type of a comeback again, or to get that steam for interest rates to improve, we're going to have to break through some pretty tough resistance levels. So it might be some time before that happens. In terms of economic data, we did see the consumer price index come in. That showed an increase of 0.3% on the month-over-month number. The year-over-year number came in going from 1.7 to 2.1. And those are on the headline numbers. So that's showing that we are above, a little bit above the Fed's target rate of a 2% inflation on the consumer price index level. So that's going to be a pretty important thing. Now, in terms of other stuff, we saw some housing data come in. Housing starts came in up 11%. Building permits were basically unchanged. Other important news that happened this week is that Federal Reserve Chair Janet Yellen actually spoke in San Francisco, and her comments actually caused interest rates also to continue to get a little bit worse. She basically said that the economy is showing just near full employment levels. They do expect, she said that they expect to hit the Fed's target inflation range, and she also said that she expects the Fed funds rate to actually be up to about 3% by 2019. Right now, the Fed funds rate is about 0.75. So that, the Federal Reserve said earlier after the last increase that they would probably have 2 or 3 more increases this year. And if they want to get the Fed funds rate up to 3% by 2009, now who knows if that's really going to happen? That's a long time away. But if that's what she's saying right now, that spooked the market a little bit, because maybe there could be even more Federal Reserve hikes coming down the pike, and maybe inflation a little bit higher than what the market is currently expecting. So all that's put some pressure here on interest rates. The day's pretty quiet today with the inauguration going on. Traders are watching that. But right now we're having a locking stance just because things are just a little bit pressure is towards interest rates continuing to get higher. If you're working this weekend, so are we. If you have any questions, please give us a call. We're happy to help in any way that we can. Once again, thanks for joining me with Java with Jared, and we will talk to you soon. Bye-bye.